Hey everyone, welcome back to Corporate Decoder. Today CMCT just filed an 8K about issuing new stock for preferred stock redemptions, and I am seeing a potential sign of pressure here. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is issuing a lot of new shares, and when that happens, it can sometimes put downward pressure on the stock price because there are more shares out there chasing the same value. So, what happened here is that Creative Media Front Community Trust Corporation, or CMCT, as it is known on the stock market, has been redeeming its Series A preferred stock and Series A preferred stock. Now, instead of paying cash for these redemptions, they've been issuing shares of their common stock. This is a pretty common practice, especially for companies that might be looking to preserve cash, or if they believe their stock is a good way to settle these obligations. Let's break down the numbers we're seeing here. Over the past few months, specifically in May and June of 2026, the company issued a total of over 9,900 shares of common stock related to the redemption of Series, our preferred stock. They also issued another chunk of over 9,000 shares for the redemption of Series of preferred stock. In total, that is around 10 new shares of common stock that have been created in a pretty short period. Now, how did they determine the price for these new shares? It was based on the volume weighted average price, or VWAP, of their common stock for the 20 trading days right before each redemption date. Looking at these prices, we see a clear downward trend. We went from about $6.36 in May to $4.3 per share by mid-June. This tells us that the market price of CMCT's stock has been falling. When a company issues stock at a declining price, it's often a sign that they are trying to meet obligations while the stock value is dropping, which isn't an ideal situation. Historically, when smaller companies like CMCT, which has a market cap currently around $9 million, issue large amounts of new stock for redemptions, it can add significant dilution. For instance, remember when Kodak did a 1-for-20 reverse split back in 2021. Holders saw their position value drop by about 40% in the following 90 days. While this isn't a reverse split, the issuance of new shares to satisfy debt obligations can have a similar dampening effect. A $1,000 investment in a similar dilutive scenario could see its value decrease significantly, potentially by hundreds of dollars, as the ownership pie gets cut into more slices. So, what does this all mean for Creative Media and Community Trust Corporation? On one hand, they are managing their preferred stock obligations without exhausting their cash reserves. However, the declining conversion prices and the sheer volume of new shares being issued are pointing to some underlying pressure on their stock price. This could be a signal that they are facing financial challenges, or that the market is losing confidence, leading to both the stock price decline and the need to issue more shares at these lower prices. The key risk I am watching here is the continuation of this dilution. If the stock price continues to fall and they have to keep issuing more shares at lower prices, it can create a challenging situation for existing shareholders, as their ownership stake gets smaller and smaller. We'll need to see if they can turn things around and stabilize the stock price to prevent further aggressive dilution. That is my take. Stay decoded. If you found this deep dive helpful, like this video, subscribe for more, and join our Discord community. All linked in the description.